Welcome to this video tutorial on the price risk monitoring and management tools developed by CSAF. The tools are aimed at agricultural trading companies, including cooperatives and producer associations, in order to improve the understanding and monitoring of price risk. For coffee sector companies that receive financing from lenders of the Council on Smallholder Agricultural Finance (CSAF), this tool constitutes a mandatory monitoring report. For this purpose, CSAF has developed a standardized tool that allows reporting the current status of purchases, sales, and financing, calculating your exposure to fluctuations in international coffee prices, applying hedging instruments if you use them, and managing price risk through dynamic and visual analysis. Tool features. The tool is developed in Microsoft Excel and allows you to report harvest progress, calculate your exposure to price risk, and generate automatic dynamic analyses that facilitate financial and commercial management. To download it, visit the website csaf.org/tools. It is available in two versions depending on the finance product, the coffee version and the version for other products. If your organization trades coffee plus another secondary product such as cocoa or sugar, use the coffee version for monitoring the harvest and coffee financing, and the one for other products for the secondary product. If you have doubts, follow the instructions from your credit officer. The tool is also available in 3 different languages: Spanish, English, or French. It is recommended to update it monthly starting from the beginning of the business cycle. Each update must be sent by email to all active funders in a single email with copy to all. The report can be complemented with additional information, such as financial statements or cash flow, as requested by your credit officer. Initial considerations. Make sure to choose the language version you prefer: Spanish, French, or English. When opening the tool, you may see messages such as Enable Macros or Security Alerts. Do not worry, simply click on Enable Macros or Content. Tool organization. The tool is organized in tabs of different colors: green to record information or blue to view automated analyses. Green tabs. In the green ones, you can start recording information. Start. For information and general configuration of your product, dates, projections, and goals. Purchases. To record purchases on a monthly basis. Sales. With the list of all contracts you have signed. Financing. For each of the active credit lines or loans. Hedging. This is only available for the coffee version, in case you manage financial instruments. Blue tabs. The blue tabs have a summary tab with the main key indicators and the possibility of adding qualitative comments to the report, and thematic analyses such as commercialization analysis, for contracting progress, collection and exports, open position analysis, and financing analysis. Navigation and help. Each tab includes an internal navigation menu to facilitate navigation between one tab and the others. In addition, help texts have been configured to simply explain what information should be recorded. The orange colored texts disappear when you insert information. The help text in each field to know exactly what type of information you should record. Some cells are protected to avoid errors. In general, green colored cells have protection, while yellow or gray colored cells are where you can insert information. Additional resources. To download the most recent version of the tool, as well as updated guides and tutorials, visit csaf.org/tools. Step-by-step process. We now continue reviewing the step-by-step process and best practices for the 4 main tabs that you will update each month. Start, purchases, sales, and financing. Start tab. We begin in the Start tab, where the general information of the cycle and the projections for the year are configured. It is important to complete this section only the first time and ensure it is aligned with the initial projections and goals of your cycle and your credit application. For the following months, you will only need to update some fields such as the cutoff date and market information. As a first step, start inserting the name of your organization, the country, the name of the person responsible,
the report cutoff date, which will change monthly according to the reporting month, the main product. You can choose between Arabica and Robusta. If you handle both species, you can record the second species or select none. The unit of measurement for sales and the total harvest estimate, the unit of measurement for purchases. In case of choosing quintals for purchases that are different from green bean quintals, for example, collection in parchment or cherry, please specify the kilogram equivalents you use as reference. Then define the key parameters regarding open, short, and long exposure limits, which will be used by the tool to alert you if you exceed recommended risk levels. These limits should be defined and approved by your management team and/or board of directors. In case of managing hedging, choose yes. Continue with the dates, reference cycle, first month of contracting, first month of coffee collection, and first month of shipping, and record the monthly collection and sales projections and percentage values. This information allows the tool to automatically generate analyses on actual progress versus planned. Finally, add market information, purchase and sales prices at the reporting date. If necessary, in case of recording sales in quintals, you can choose between 46 or 45.36. Lastly, add information about your projected costs and expenses that you have used in your planning and cash flow. This will serve to project income statements and break-even points in the analysis tabs. Purchases tab. The Purchases tab is updated each month and is fundamental for maintaining the price risk exposure calculation. It is recommended to follow these best practices. Record the collection configuration, species, Arabica, or Robusta purchase form if it is direct from producers or from other organizations, purchase stage, for example, green bean, parchment, or cherry, and initial inventory from the previous harvest, if applicable. Then, continue with purchases for each month, inserting the actual volume collected, the average price paid in local currency, the exchange rate for each month. The tool will automatically calculate the total cost in dollars. Then record the yield and final exportable volume of the process or milling. At the end of this value, the tool will calculate the final sales volume and the average collection price in dollars with adjusted yield. It is recommended to include a monthly comment if there were unexpected reductions or increases in collection, weather problems, cost changes, significant differences from projections. If your organization purchases in different modalities, for example, Arabica and Robusta, cherry and parchment, from producers and/or third parties, you can activate a second or third table by selecting yes. A second table will automatically appear after the first one. In the analyses, it will be possible to see the total values of the 2 or 3 accumulated tables converted to green bean quintals. Sales tab. In the Sales tab, you should record all signed contracts organized by lot and shipment date. As a first step, you must complete buyer name, contract and lot number, destination, if it is export or national market, certifications, and expected volume and shipping month. Then continue with contract type and pricing information. For fixed price contracts, enter the price directly. For open contracts, if you have a guaranteed minimum price, you can add it until you have your final price fixed. Then the market position will appear. You can find it on the ICE page depending on the month and year of delivery of your contract. And finally, any differentials. When the price is fixed, record the amount and the fixing date. Finally, update the status of your contract and shipments. Update the contract status each month. When it gets shipped, record the actual shipment date. The tool will automatically calculate if it was delivered on time or late. The last columns refer to the possible financing associated with contracts. Indicate if your contract has been financed by a lender and the percentage of the finance value. Finally, record the payments received and outstanding balances. Financing tab. In the Financing tab, all active credit lines and loans are recorded, regardless of the lender. The first time, record the lender's name, the contact, and their email. The approved amount, maturity date, and collateral. This way, each month you will only need to update the disbursed amount, the previous report's disbursement, and the current balance. There is a last section for comments, where you can explain delays in disbursement, changes from the financing plan, risks, and important deviations. Hedging tab. In the Hedging tab, viewing from left to right, the upper table summarizes the accumulated physical open position, the financial position, and the net position. This is the most important section of this tab. If your company does not use financial derivatives, you should only pay attention to the physical open position and to the net, which will be the same. This data will serve you to manage your physical hedging strategy. The physical open position has information in the purchases sell of how much you have bought in sales, how much you have sold at a fixed price, and in the next cell by arithmetic subtraction, it is determined if you're long or short. In this example, there are 2,145 long quintals. In the lower part, there is a record of financial hedges. However, before filling in this section, you must determine if you're using this type of financial market tool. If you are not using financial hedging, do not fill in this section. Otherwise, first fill in the tables that are to the right of the hedging registration table, called hedging expiration, and has two subtables. One that says options expiration and futures expiration. There you must look for the expiration date of the coverages. First, the expiration date of the options in the options expiration calendar. For example, from Bar Chart, which is one of the trading platforms. In the case of futures contracts, the first notice date must be recorded and the data provided on the IC Futures platform is used. Later in the hedge registration table, you insert the type of hedge, call, put, or future that is being managed. Then its status, open, close, or at market. In the next column, the type of operation, purchase or sale, the quantity. And the position of coverage, which is the stock market position to which you are taking the coverage. By defining the number of contracts in the covered volume column, the number of contracts is automatically multiplied by the volume of one contract, which is 375 quintals on the exchange. Later, the trigger price of the coverage is completed, which in the column is called strike price and the purchase date. The expiration date is automatically created and in the cost column, you register the value paid for the coverage. The next column automatically totals the cost of the coverage. In the next column, you register the date on which that hedge was executed, the value of the execution or closure, obtaining the total execution value. This is netted with the value of the execution cost and the compensation column. And in the next column, the net value of the coverage is automatically recorded. This last value accumulates to record the cost of closed compensation, which will also be recorded in the income statement. The operation type column will be completed automatically, and then an observations column for your notes follows. Analysis and monitoring. For an impact fund and for an exporter, the real risk is the same: tied capital, delays, exposure to price volatility. This tool functions as a dashboard that allows monitoring of commercial execution, price risk exposure, and cash. The file creates 4 tabs: Summary, Commercialization, Position, and Financing. The operational rule is to start with the summary. If something catches your attention, explore the details in the other tabs. Summary tab. The summary indicates you if the operation is under control or if you are already accumulating risk. In short, the first part is commercial and it includes 4 main signals. 1. Contracts in progress. 2. Collection, volume, value, and progress. 3. Price fixation. What part already has a fixed price for? Exports. How much has actually been dispatched? Afterwards, a quick reading is made about open position, preliminary results, and financing. Important point. This monitoring sheet is a snapshot of the moment. It shows the operation at a specific instant. Commercialization tab. Here we see the first commercial alert: the gaps between collection, fixing, and export. A gap here is a commercial alert, as it costs you money even though the price looks stable. In the first graph, you compare 3 things: collection, price fixation, and export.
This graph is very useful for evaluating the moment of the month and for understanding monthly behavior. If you collect, but do not export at the same time, the risk is not theoretical. There is an operational bottleneck. You should formulate control questions to understand the delay, such as, how are internal processes going? Quality, documentation, shipping lines, or installed capacity. Then compare projection versus actual. If collection is delayed or advances compared to projected, 2 things change: working capital requirements and financial costs. In collection times, the greatest risk is lack of liquidity. The same applies to export. If actual export falls well below projected, an action must be taken. It is critical to understand what is happening and to define a recovery plan, because that affects cash and contract compliance. Position tab. This tab allows you to monitor the open position. Here there is a financial risk. Being long without realizing it is the most common way to incur a loss when the price falls. The physical open position is simple. If collection is greater than fixings, you are long. You have an inventory exposed to coffee price volatility. This is compared with the approved commercial policy, how much risk is acceptable and until when. You can also be short. That occurs if you fix more volume than you collected. In that case, you are exposed to the volatility of the local collection price. Ideally, the position should be as close to 0 as possible. The second graph shows the variation of the physical open position around 0. The values are relativized, and on the vertical axis, quantities are shown in green bean quintals or the unit you used. Example, 10,000 long quintals may be only 2.6% of the exported volume, but in a narrow margin business, 10,000 quintals can be $900,000. Therefore, it is important to identify extreme values, understand how they impacted, and verify if they were mitigated during the course of business. Then the net position comes. Here you incorporate financial hedges.
You can be physically long, but protected with options or with futures contracts. To measure financial risk, the net position is what matters. In Table 4, income statements and break-even point, here actual, is compared with projected and you monitor the margin per quintal. If the exported volume is low, sales and cost of sales do not yet reflect the expected progress. Then the break-even point is reviewed. If actual volume falls, the break-even point rises because fixed costs are diluted in fewer units. This is an early warning. It indicates pressure on profitability. Financing tab. Here there is a practical rule. If your inventory is worth more than your financing, someone is financing and sometimes it is the producer. In the first graph, 4 values are compared: projected, approved, dispersed, and outstanding amount. If the value of collection exceeds the disbursement, you have a working capital gap. Here you need to define a cash plan, payments to producers, payments to suppliers, and have clear priorities to avoid breaking trust. If you turn over a credit line several times, disbursements can exceed the initially approved amount. That should be specified. You have to review the concentration. If a single institution provides more than 40% of funding, you have a strategic risk. Manage the relationship and diversify. In the detailed graph identifying each funder, you can see where there is room to request more working capital, which is the difference between dispersed financing and approved financing. If doubts persist, contact your credit officer. Thank you.